Good morning, everyone. As my slide says, I'm here to talk about bonds and perpetuals. And I've always thought that it's difficult to explain bonds and perpetuals until I heard Professor trying to describe cryptocurrencies. I work for Lion Global Investors, and I just want to put things in context. The part of the business that we're in is that my job requires us to buy bonds on behalf of funds. So in that aspect, we are quite similar to you guys when you're buying bonds, right? So I'm not the side that sells bonds to the public or to counterparts. I'm the investment side. So with that, I'm here to share some of the things that we look at when we go about buying bonds. So cryptocurrencies have been in the headlines recently, but so has bonds. And actually, bonds are supposed to be very boring instruments. So unfortunately, in bond land, we have had some negative headlines. So we want to share with you some of the things that we look out for. So some of these headlines, I'm sure you have read or come across. So before that, let's have a quick take on what are bonds and why do people buy bonds. Now, I suspect most of you know what a bond is. When the company issues bonds, it's essentially borrowing money from you, right? So when you buy a bond, you are lending a company money. So why do people buy bonds? All right, so there are definitely benefits of buying bonds. Earlier on, the earlier speaker, Abel, spoke about, conservative investors, you just put all the cash into FDs. Now, bonds pays higher interest rates than FD, right? You are taking some amount of risk, which I'll talk about later, but most people buy bonds because the rates are higher. As my slide says, you have a regular stable cash flow. And bonds are generally safer instruments than stocks. So later I'll show again why are they safer. And bond forms a big part of people's portfolio, whether is it your retail portfolio, institution, governments, pension funds. Bonds, a lot of times, because they tend to be less volatile, they form a core part of a portfolio. And when you add a bond to your portfolio of, let's say, stocks, and it will bring down the volatility of your portfolio. So what are the risks in buying bonds? So I just want to highlight 3 risks. First of all, credit risk, because you're lending money to somebody, right? So you're taking on the credit risk. So I'll be elaborating a bit about how we as investors how we look at credit risk, interest rate risk. So earlier on again, we heard about how potentially rates are going to go even higher. They have gone up quite a bit this year, and chances are it will continue to go higher. So when you buy bonds, especially fixed rate bonds, you are taking interest rate risk. And of course, if you buy a non-Sing dollar bonds, you are obviously taking currency risk, right? So currency risk, I'm not going to elaborate, right? I think that's pretty obvious. If you buy US dollar bond, you are exposed to US dollar risk. So early on, I spoke about why bonds are, in general, safer than stocks. So this is a general structure or capital structure of companies. So on the left-hand side, this is like your balance sheet, right? On it, you have the assets, and the assets are backed by your liabilities and in your equity. Liabilities would be bank borrowings, bonds. So I kind of put a simplistic picture here, right? I mean, in real life, you can have all kinds of, little different permutations. So on the right-hand side, on the liability side, you have, first of all, senior bonds, followed by subordinated bonds, and followed by perpetual. Now, perpetuals have been in the limelight recently, unfortunately, again, for the wrong reason. So perpetuals, in general, they tend to be found somewhere between equity and bonds. But here, I need to highlight that this is not always the case. There will be times when perpetual can be ranked senior, right? For this, you have to check the terms and conditions of your bonds, the offering sheets, right? So as what you keep hearing, you have to do your homework when you invest into these instruments. You have preference shares, and this is pretty popular, maybe about 10 years ago, you have the banks that issue preference shares. Increasingly, these are getting called, and you'll see less and less of these preference shares. And of course, right at the bottom, equity. Now, on the right-hand side, you can see that your risk, as you go from top to the bottom, your risk would increase, right? So bonds are lower risk compared to equity. And why is this so? Because if the company gets into trouble, so imagine the company's assets, for some reason, they face financial difficulty, they have to do a write-down. And what happens when you write down? You take losses from bottom up. So if you're ranked right at the bottom, you are first to take the loss, right? Conversely, if you're ranked on top, you're further away from the losses. So if you are on top, your risk is lower. Right now, the right-hand most column reflects your return, right, in the form of your interest or dividend. So bonds being ranked on top, being the lowest risk, you tend to get the least. So your interest rates or the coupon that you get tend to be lowest. Then as you go down, your subordinated bond pays you a bit higher. Perpetuals will pay you even higher. And then as you go down, equity takes, your equity risk, right? Any excess cash flow equity takes. So obviously, you have to think about, when you're investing in these instruments, you have to think about where you are in the capital structure. So perpetuals, for example, perpetuals are a lot of time not necessarily rank the same as bond, right? They are kind of, sometimes we call it hybrid instrument. Why hybrid? Because it's a cross between equity and bonds. So we need to highlight that, please do not get combine them to be same as bonds. So I just want to go through some of the bond features, and after this slide, I have a corresponding slide showing perpetuals. So the first slide is to tell you quickly what are the main features of bonds. Then I have the similar slide on perpetuals. So first of all, a bond, when we trade a bond, the price is quoted something like 100.50. We call it par 50, right? It's actually expressed as a percentage, but expressed in terms of points. So if you buy a $10,000 worth of bond, if the price is like this, you're paying $10,500. Okay, so you take this, you divide by 100, so it's 1.005 multiplied by your notional amount. So that's the bond price. So next is the coupon. I think that's very straightforward. Coupons, that's the interest that company has to pay you in return for investing into the bond. The coupon can be annual, semi-annual, and sometimes quarterly. Next is the yield. So in this case, in my example, I made it such that the bond price is a bit higher. So if you buy a bond at 100.50, when a bond matures, you get back 100, right? So you will so-called lose that 50 cents that you paid for, okay? Now, because you lose that 50 cents, your yield, therefore, is not the same as your coupon, right? Because you're paying par 50, you get your coupon of 2.88. When the bond matures at par, your total return cannot be 2.88. It has to be less. Therefore, in this case, your yield, think of it as your total return after everything, is 2.7, okay? So the big caveat here is there's no default. There's no default, you get back 2.7 when the bond matures. Next, we have the maturity date. So in this example, the bond matures in June 2021. So that's pretty straightforward. Now, the maturity is in 3 years' time, right? Today we are 2018 July. This is a 3-year bond. But when you calculate duration, it's a bit less than the maturity. So it's not exactly 3 years. There's a mathematical formula behind how you go about calculating duration. So in this case, this example, the duration is 2.8. So later I'll talk about what does it mean for a bond with duration of 2.8. We call this a bullet bond. There's no call date, right? The bond matures in 2021. Now this bond is rated BBB+. At this point, I need to highlight, as you probably know, a lot of the bond offerings in Singapore are not rated. So that's one challenge that retail investors like yourself have to face when you invest in bonds. The bonds don't get rating. There are a couple of reasons why bonds don't get rated. The big blue chip companies, they don't need a rating because to them they find it troublesome, costly, and if they find that they are able to issue bonds without having to go through a process of rating, they'll go ahead and do it. And these big blue chip companies, they have a ready base of investors ready to buy their bonds. So they don't have this problem of selling the bonds. Then you have the other spectrum where the companies probably don't want to get rating because they won't get a good rating. So because they won't get a good rating, it's like you pay for something and you get bad rating, it defeats, or rather it hurts their selling process. So in our mind, this is why a lot of times Singapore companies do not get the rating. The international bond investors, the one that the global bond issuers, they do tend to have a rating because the international investor base requires a rating, right? Because if you don't get a rating, then people would then start to get suspicious. Hey, why is it that you don't have a rating? So this is the unfortunate situation in our Singapore corporate bond space. So this is typical features of bond, pretty straightforward. Now, this same company also issues a perpetual, right? And if you look at the column on the right, I'll talk down the rows. So in this case, the perpetual price is 101.5. The coupon is higher, it's 4.5. So earlier on it's 2.88, now it's 4.5. So why does it pay higher? So remember earlier on, I show you the capital structure. In this case, the perpetual is ranked below the senior bond, right? So this is why the company has to pay more to attract people to buy something that's more risky. And this 4.5 coupon is deferrable. So what does it mean to be deferrable? It means that the company don't pay you 4.5 and it is not a default. In the earlier example, the 2.88, if the company doesn't pay 2.88, it is considered event of default, right? And then obviously, you have all kinds of things happening. In the case of perpetual, if that year the company doesn't make enough money, it can don't pay you your 4.5% coupon, and there's nothing wrong with that. Okay, so please be mindful of this. In calculating the yield of this perpetual, in this case, I have a 4.04% number, and I put that yield to call. This is assuming that the perpetual get called. Okay, if you look a few rows below, the call date is 2022 at 100. So if the company calls back this bond in 2022 at 100, your yield to call is 4.04. In other words, your return after the bond gets called is 4.04. Okay? The big caveat here is if the bond gets called. In terms of maturity, in this case, a perpetual does not have a maturity, right? So in other words, it can go on forever. And you as an investor, it also means that you can never get back your money if the company doesn't call back the bond. So we just want to highlight something here. You get a higher yield, for investing in perpetual, but bear in mind that the two points I mentioned. The company can actually don't pay you coupon because it can defer, and there's nothing wrong with that. And the company don't call back the bonds because it is a perpetual. Meaning that, if you're trying to plan for retirement, you want some amount of cash flow at a certain point in time. If the company says, okay, I'm not going to pay you back because I have some difficulty, from the company's point of view, that's actually nothing wrong. Okay? So be mindful of that. The duration, in this case, is 3.16. Again, this is the duration that's adjusted for call. If the company calls on that date, this is the duration. Obviously, if the company doesn't call, then the duration will be something else, right? It's a longer dated than your 3.6. So again, imagine you're planning, okay, I need this cash flow in 3 years' time. and company doesn't call, then we face this thing called the extension risk. The company will delay the call for another year, and you have to wait. And you have to keep waiting and waiting until the situation in the company improves. Then they call back the bonds. So we spoke about the call date. In this case, the rating is a BBB minus rating. Now, I spoke about how in Singapore banks are not rated. So, bond issuances are not rated. So in this example, this is a real life example, but I can't reveal the name of this issuer. Here, the rating is, how do I get this rating? This is our in-house rating. So internally, we have a team of analysts that looks at this, the company, the balance sheet, speak to the management. From there, we derive a certain rating. So we gave the senior bond a BBB plus rating, and the subordinated bond a BBB minus. So notice the difference. There's actually a 2-notch rating difference, right? The way the rating goes is, it's BBB plus, then BBB without plus minus, we call it BBB flat, and then BBB minus. So it's actually a 2-notch difference between a senior unsecured bond and a perpetual bond. Now, in this case, why are there 2 rating difference? The first notching is because this is a subordinated bond. So in ratings, when we rate bonds, if it's subordinated, we give it a -1 notch. Okay? The second notching comes when the coupon can be deferred. So that results in 2 notching difference. So this is to so-called penalize the perpetual. And we do this so that when we look at this and we look at it, okay, this is a BBB minus. My credit analyst gives it a BBB minus. That gives me a better sense of how to price this bond, whether or not, well, first of all, because it's different rating, it cannot be trading at the same yield. So the yield cannot be the same as the senior bond. The yield has to be higher. Because I'm taking more risk, I need to be paid more. Okay? So that's the difference in the rating, and the rating tells you why the bonds should be priced differently. Okay, so next we'll look at credit risk. Now, earlier on, I mentioned there are 3 risks: credit risk, interest rate risk, and FX risk, but I'm not going to talk about FX risk. So first of all, on credit risk. You see, when we invest in bonds, bond investors are faced with this thing called the asymmetric return. Asymmetric means it's not, your upside and downside is not equal. When you buy a bond, unlike a stock, okay, a stock your price can double, it can drop a lot. When you buy a bond, the upside is always very limited. Okay, as you can see from this chart, right, the bond was issued at close to par. It goes up a bit, and then when something goes wrong, it can drop a lot. So you buy a bond at 100. The upside is maybe kind of best case scenario 105, sometimes 110. But if something goes wrong, your 100 can drop to 50, can drop to 30. So at first glance, it sounds like this is not a good trade-off, right? I mean, your upside is very limited, your downside is all the way. But obviously, there's a way to look at this. You don't just dismiss a bond just because of this. So because of the asymmetric return, you have to bear in mind 2 things. You have to manage your credit risk very carefully, and of course, diversification. So let's first talk about credit risk. So earlier on, I kind of mentioned about how we do it in-house. We have a team of credit analysts who looks at the balance sheets, look at financials. So the framework is pretty straightforward. You look at the business, right? You look at the industry, the competition, the management. These are qualitative factors, okay? So this part can be subjective, of course. Now then, there's a financial analysis bit. So financial analysis is where you look at the balance sheets, and these days, with internet, your access to information is actually the same as what the institutional investors have, because everything is online. All the published informations are all online. It's all made available, so you can have access to this information. So let's spend some time looking at financial analysis. So here I have an example of what we call this a rating matrix, right? So the first table shows you that for industrial company, this is what we look at. So if you look at the first red circle, I'll just highlight one one factor that we look at. So in this case, if this company, the total debt to EBITDA is 2.44, as seen in the red circle, we would rate it a triple B. So what does this number mean? Debt to EBITDA. So think of yourself, imagine a person working, let's say he's earning maybe 100,000 a year. He goes to a bank, he says, I want to borrow 250,000, right? That's roughly 2.5 times your annual salary. Okay. So, and this is of course unsecured, right? So don't think of this as your mortgage, think of this as an unsecured bond. So the bank therefore will see this company, or rather investors will see this situation as a triple B company, so a 2.4, 2.5 times debt to how much you earn. Now, I'm highlighting this, in the first slide we spoke about all these companies that got into trouble. So those companies, if you look back and roughly the year or so before the bonds were issued, their numbers were probably all the way to the right? It's all like more than 5 times debt to EBITDA. So I just want to give you a sense of where to frame this credit risk. So if it's something like 5 times, so imagine again, example, if you're earning 100,000, you go to a bank, say, I want to borrow $500,000. The bank will see you as a very high risk with 5 times your annual salary. Okay, so that's a single B or even worse. So that's one example of debt to EBITDA. So obviously, we can't just rely on one. Okay, so earlier on we spoke about the qualitative factors. These are the quantitative factors. I've got a list of other factors that we look at. So what we do is that we'll assign a score to each of these ratios, and we kind of combine them to see what is the average rating we assign to a corporate. So the first example was for industrial. The second table here are for REITs. So in this example, the second red circle, I looked at the debt to total assets. So how much of the total asset the REIT has, how much of that is in bond? So here in Singapore, MAS has this regulation. The REITs cannot exceed 0.45. So now if it's got 100 million of assets, the REIT cannot borrow more than 450 million. Right? So that's the MAS rule. Now in the rating space, what does this translate to? So as you can see in my table, this roughly translates to a triple B score. Right? So I've used triple B as an example because triple B is what we in triple B rating, these are called investment grade bonds. Anything worse than triple B, meaning on to the right, double B, single B, those are, they call it high yield, or some people call it junk bonds, right? So high yield is a nicer sounding name, but essentially both are not investment grade, right? So these tend to be more risky, okay? So that was on interest rate credit risk. So now we talk about interest rate risk. So when you invest in a bond, you are taking interest rate risk. So earlier on, I spoke about duration. You are taking duration risk. For bonds that are callable, in this case, perpetual bonds or callable bonds, you are taking call risk. The risk of the issuer not calling. So in the case of perpetual, if it doesn't call, you actually don't get your money back until much, much later. So on duration, now, my earlier example, I showed a difference between duration and bonds, duration and maturity. So in this example, this is a 5-year bond. Maturity is 5 years. That's pretty straightforward. The duration is a time-weighted average of your cash flow. So think of the different little bags of money. That's your cash flow. Right? If you want to have an analogy, this is think of it as a seesaw, right? And then your balancing point, where it balances your different cash flow, that is your duration. So duration is always less than maturity, okay? And duration is important because it measures how sensitive your bond is to changes in interest rates. This is important because earlier on we spoke about how interest rate could be rising. So you have to pay attention to duration. So to give an illustration, if you have a 2-year duration and a 5-year duration, what happens? So in the 2-year duration, for every 1% change in interest rates, instantaneous, meaning immediate, your bond will straight away fall by 2%. So that's very straightforward. Duration measures sensitivity of your price to interest rates. So on the right-hand side, with a longer duration, if interest rate go by the same amount, your bond will fall by more. Right? In this case, it drops by 5%. So be mindful of this, because we are likely to be a rising interest rate environment. If you buy a longer dated bond, you are taking more duration risk, and if risk indeed go up, then you tend to lose more. So the next risk is the core risk. Now these are, you see, when we buy callable bonds or perpetuals, as an investor, I want to know what's my likelihood of call. And all things equal, I want to have a situation where I can be more confident that issuer will call back. So what are the factors that will incentivize or make the issuers more likely to call back? So I'll frame it the other way around. From the issuer's point of view, under what situation would they not want to call back? So first case is interest rate drops, right? So interest rate drops to, imagine interest rate, okay, let's use the earlier example if you recall. The earlier perpetual, the company issued a coupon of 4.5%. So when interest rate drops, they are likely to call back. Sorry, I got it the other way around. They are likely to call back when interest rate drops because they can issue a new bond at a lower interest rates, right? So now we are in the opposite situation. When interest rates are rising, they're actually less likely to call. So that's your risk in investing in perpetuals. So another thing to encourage issuers to call back their bonds is in the coupon step-up or reset. So a lot of times, what's inside the bond structure, the perpetual, for example, is that if company doesn't call back on that date, the coupon will step up to be higher, so that it becomes more punitive for them not to call back, right? So you want to know what is the step up or what is the reset in the interest rates. Obviously, if the reset is very little, there's not much incentive for issuers to call back. But the change, if the rate is very high, a lot higher, then the company would, they don't want to pay the higher interest rate. They will want to call back their bonds. So look out for this coupon reset or step up. Now, bear in mind that the step up or reset date does not always coincide with the call date. So that's a bit tricky situation. There was actually an article in yesterday's Business Times that spoke about this. So just bear in mind, it might not always be the same as call date. The last point is this thing, what is known as the loss of equity credit. Now, this happens in bonds that are rated by external rating agencies. So companies sometimes issue perpetuals, and these perpetuals are recognized as equity in their balance sheet. So when they recognize as equity, it makes their gearing looks better. And a lot of times in the document, if they do not call back, these instruments do not qualify as equity anymore. So then if they don't call back, they lose the equity credit, and therefore the rating could potentially drop. So again, another point to incentivize issuers to call back their bonds. So that was on interest rate. Now, I just want to have a quick slide on diversification. So earlier on, we spoke about credit risk, right? To manage credit risk, you do a credit analysis, you want to diversify. This is to manage a downside risk. The question is, how much is considered diversified? To me, a rule of thumb is when you invest in that one issuer, you have to ask yourself, what if something goes wrong? What if you lose half of that amount? How painful is that to you? Obviously, if this bond that you buy is, let's say, half of your portfolio, and you lose half of that, obviously that's going to be very painful, right? But if you put at a smaller percentage, let's say it's maybe 5% of your portfolio. If 5% you lose half, that's 2.5%. That's not that painful. So I use 5% because for the institutional investors, that's roughly the range. In fact, 5% is a bit on the high side. Typically, what we do is the rule of thumb is between 3 to 5%. And these are for investment-grade bonds. If high-yield bonds, most of the time it's less than 3%. Now, the challenge in this to retail investors is obviously in the retail bond market space. I know it's very hard to diversify. First of all, there aren't that many retail bond offerings. And number two, the ones that are available to the private banking guys, the typical minimum denomination is 250. So that also presents a challenge. So even if you have, let's say, $1 million to invest, you buy 4 bonds, 250. That to me doesn't sound very diversified. So that's the unfortunate truth about investing in corporate bonds for retail market. So other than issuer diversification, there's also this thing about sector diversification. So, we had a case where the last few years, the offshore marine sector got into trouble because oil price collapsed. Now, so early on, imagine if you say, okay, yeah, I'm diversified, I buy 10 bonds. But what if your 10 bonds are all in offshore marine space, right? In fact, almost all of them are in trouble. So you must also be mindful of your sector diversification. So don't just buy everything in one sector, right? Because when things are rosy, everyone thinks that it's fine, your guts are down. But be mindful that sometimes things can turn out, or situation can change very quickly and very drastically. Okay, I'm coming to the end. So obviously, the point we're trying to make is that you have to do your due diligence, do your homework. The information is all out there, right? It's all in the bond offering documents. The banks, when they sell you the bonds, they have this thing called the product highlight sheet, right? So the bankers, when they sell the bonds, ask for this piece of paper, read about it, and after you invest, keep track of your investments, right? Be informed of company news. It's again through the website. A lot of the listed ones, they make announcement on SGX. So do keep track of your investments. And lastly, if there's the distress in the issuer, so typically what happens is that the company would have to find a way to restructure the liability. Typically what happens is that the situation change, operations are not doing well. It can be, let's say, a drop in oil price or something has changed. The company finds that the amount of debt they have is too big that they can't go on like this. They have to find a way to restructure. Restructure could mean maybe getting the bondholders to lower the coupon, change the timing of the maturity. So these are things happening to restructure. And when bonds go through restructuring, there's this process called the CSE, consent solicitation exercise, where they get the consent of the bondholders to agree to the restructuring. Sometimes when you can't come out to a resolution on restructuring, then the company might have to go through judicial management. This is when an independent advisor comes in, and the company then will be shielded from all these legal liabilities, so that the company can get its operation back on again. And in a liquidation scenario, your investment depends on the ranking. So remember the earlier slide, you have to know where you are ranked in that space. So with that, I end my presentation. Thank you very much for your attention.